With interest rates surging here in 2022, a lot of people have got excited about things like brokered CDs and U.S. Treasury bills. Well, if you've bought these things as interest rates have risen, chances are you're sitting on some losses. This has people scratching their head. How could I have losses on something that's guaranteed by FDIC or the government itself? Well, today we're explaining the mechanics of how these instruments are priced. And if you're curious about the Truman reference on the thumbnail, stick around to the end. Now, first and foremost, at the most basic level, if you buy something like a brokered CD or a U.S. Treasury bond or Treasury bill, as long as you hold till maturity, you cannot lose your principal. Okay, they're guaranteed by the government. It's an actual contract. What we're really talking about in today's discussion is what happens in between the time you purchase and maturity. Why does the price fluctuate around? Now, the best way to explain this is to look at a couple of examples. So let's say, for example, you're interested in putting $10,000 into a one-year brokered CD. And at the time you were going to make this purchase, rates were hovering at 4%. So on paper, here's how it looks. You're going to get 4% of 10 grand, which is $400 of interest over the course of the next year. Now, here's the important point. If interest rates broadly stayed flat for the entire term, the entire 12 months, the market value of your CD would be unchanged. It would just stay consistent with face value. The real question is, what happens if interest rates change? Specifically, what happens if they go up while you're sitting on a contract with a fixed 4% rate? So for example, let's just say, hypothetically, the day after you bought your 4% one-year CD, interest rates jumped, and now you could buy the same CD for an entire 1% more, paying 5%. Well, what would the market do? How would it reprice your 4% rate? Because obviously, here's the fundamental question. Who is going to buy a 4% CD when they can buy the exact same thing now paying 5%? That's the issue. So the market, therefore, is going to reprice that 4% CD accordingly. Here it is. So here's our same CD, $10,000 face value. Everything's the same, but now the market value of the CD is down to $9,904.76. So why $9,904.76 exactly? Well, the math is up here in the corner. So another way to think about this is, imagine that you had to sell your CD, your $10,000. This is what you originally paid. You had to get out of it before maturity. Well, because interest rates have gone up, nobody's going to want to pay $10,000 for a 4% CD when they can just go to the market and buy a 5% CD. So the market's going to only offer you this discount. And this number isn't coincidental, it's not random. Here's how it works out. So if someone bought your CD from you, but they only paid $9,904.76, here's how their return would look. Their return is going to be made up of two parts. Appreciation of $95.24, because when this CD matures, it's going to pay out at $10,000, remember? That was the original deal. Plus, it's going to yield $400 of interest, which is the original 4% on $10,000. So the total $495.24 works out to exactly 5% of $9,904.76. Now, if all this bond math is confusing and difficult to follow, don't worry. You're not alone. In fact, our 33rd president, Truman himself, didn't seem to have a good grasp of this, and I'll circle back to Harry in a moment. But before I do, I really want to emphasize again what I think is the most important point, and that is if you buy a brokered CD, or even a Treasury bill for that matter, and hold to maturity, you're not going to lose your principal, okay? It's guaranteed. Basically, all the things we're talking about only matter if you're trying to sell before maturity. Otherwise, the market value is just that. It's just fluctuation on paper. But this brings me to our old friend here, Truman. So if we go back to 1951, it's kind of interesting, the parallels with today. So 1951, inflation was running hot in the United States. In fact, it was running at over 20%, which is over double the current rate we've experienced most recently. Anyway, the Federal Reserve wanted to raise interest rates, again, much like what's going on today, to cool things off, bring inflation down. But Harry Truman, president at the time, was adamantly opposed to this. Question is why? Well, the story has it Truman's family owned a bunch of these Liberty bonds, which were government bonds issued during World War I to support the war effort. After World War I, interest rates went up, which of course means bond prices went down, and evidently Truman's family sold their Liberty bonds at a loss. And President Truman never forgot about this. So when here he is sitting in the White House and he hears his Federal Reserve is going to start raising interest rates, he was obviously very concerned about this and did not want to have anything to do with it because he knew what the impact would be for all the bondholders across the United States. And this was despite the best efforts of people on the Board of Governors of the Federal Reserve, and I think people in the Treasury that tried to convince him, Mr. President, as long as bondholders hold to maturity, they're going to get their principal back. And Harry Truman evidently didn't want to hear anything of it. It's a great story. Go back and read about that one yourself. But long story short, don't be Harry Truman. Remember, as long as you hold to maturity, you're in good shape. Anyway, I just want to say thanks for watching. Probably got a little bit too long-winded at the end here, but I hope we will see you on the next one.